Now, condos, this is where it gets really funky cold Medina right here. So we looking at 55% increase compared to last year, just like the Ronco commercials. But wait, there's more. This is the real big increase, 128% more inventory on the market, more than double than there was in 2023. And we look at pre-pandemic, it's actually up. There are more condos for sale right now than there were in 2019. And again, Paul, this is really just highlighting that divergence. What do you see when you look at this?
Market trends and forecasts, outlook for buyers and sellers, key insights from the experts. Welcome to the Hawaii Housing Report with economist Paul Brewbaker and Patrick ONeill.
Well, houses are hot. Condos are not. Welcome to the Hawaii Housing Report. I'm Patrick ONeill, joined by Hawaii's #1 economist, Mr. Paul Brewbaker. Paul, you gave an extraordinary presentation at the mid-year real estate event up at Oahu Country Club. I hope you enjoyed it as much as I did.
Well, considering that it's already outdated, yeah, it was a lot of fun.
Yeah, it was great. That's the 17th year you and I have hosted that together, and it's
Crazy.
sold
That's
out
crazy.
event. I know it. I can't believe it.
It took me
But
10 years to realize we were doing it every year together. So anyway.
that's good. And pre-COVID, it was 2019, the last one we did. We were at Waialae Country Club, and you said nothing really is going to change that much unless there's a biological event or a geopolitical. And man, did you nail that one? And then COVID hit 6 months later. So anyway, okay. But the one of the big themes of that is really this continued divergence between single family homes and condominiums. We're seeing strong price growth in single family homes due to scarcity, lifestyle choices. And then the condos are suffering from a multiple of issues, including the affordability issues, the insurance issues, the vintage, investor hesitation, et cetera. We're going to get to, I think, the most shocking statistics, which is the inventory. But let's start with pricing, where we can start to see this. And I'm going to pull up the statistics from the Honolulu Board of Realtors. And I know you have a really good slide that we're going to look at in just a moment about the pricing. So again, thanks to the Honolulu Board of Realtors for providing this data. The median price for year-to-date May was $1.16 million, which compared to last year is up 8%. Strong. That's strong annual price growth. Compared to 2 years ago, 10.5%. If I do simplistic math, that's 5+ percent per year, which certainly would be keeping with long-term trend. Now, when we get to condos, it's a completely different story. 505,000 is the median price. Zero change from last year, is exactly the same price, and compared to 2023, up only 1%. I mean, this is really where you start to see this separation. What are your comments on this, Paul?
Yeah, kind of a sideways split there. And let's remember the interest rate environment that both market segments face is essentially the same. And so whatever's going on in one part that's not going on in the other has to be specific to that part. The list for condos in recent years of, kind of stigma issues, or I mean, I hate to say that because condos are the affordable segment for buyers here in Honolulu, but there have been challenges with insurance costs, with the maintenance and operation expenses of older buildings that have, it's depreciation, uh, and um, and the short-term rental controversies. I think a lot of people who are interested in condos like the idea of the optionality of a short-term rental. And as jurisdictions slowly close the window of opportunity there, the optionality goes away. And that's kind of like, well, that was like the icing on the cake. The cake's still good. It's a condo in Honolulu. How bad is that? But if all I can do is either live in it or rent it long term, I'm going to think a little longer about that. So the energy is just not there. And when you look at these two paths side by side, let's take out the seasonality. Let's uh, benchmark to the paths that were established back in the 2000 teens, the 20 teens. So you can see there that nice escalator-like trajectory. Um, little bit different from the roller coaster we went through in the 80s and the 90s and the early 2000s. So here we are on the escalator of life. Along comes the pandemic, and it does a couple things. On the single family side, it creates this overshoot, this little bubblicious, I don't know what that is, what the hell is that? And right now, it went up, came back down, looked like it was going back to trend, and then it decided we're going to go parallel to trend, but stay above it. We're not going below it. And right now, 1.17 million, 1 million, as you say, is higher now than at the peak of, what is that, a remote work bubble? I don't know. Whereas condos, you can see on the bottom, kind of decided after 2022, dude, we're going sideways. Sideways is good enough. Sideways is good for affordability. The interest rates haven't come down, but the prices haven't gone up. What you see is what you get,
Yeah,
you know?
and the affordability is really being hurt by these extra costs, the insurance costs, the vintage problem, those sorts of things.
Gotta
And to
be.
distinguish between the two markets, new condo market is completely separate. You know, the Howard Hughes and the
Oh yeah,
Ward Village,
no.
that stuff is selling out. But we're talking about the vintage stock. And I think you said before, 80% of our stock was built before 1980 or 90%, whatever the figure is.
Oh yeah, I mean, we're talking about hundreds of thousands of existing condos, and then like 500 new condos over here and 200 new condos over there. So the new products not having a massive impact on what's going on in the resale market. And when you take out the trends and look at the two segments diverging in performance, this, as you said, single family prices are about 8% above trend in this case. And condos right now, again, dominated by the older inventory, are sitting at about 15% below trend. And that's a tale of two segments moving in completely different directions for reasons that are specific to those segments.
Yeah. Okay. Well, let's take a look at this next set of statistics. When I read this is more shocking than finding metered stall in Waikiki. This is incredible. So let's take a look at this again from the Honolulu Board of Realtors. Okay. Active number of listings for sale. So let's start with single family homes. We can see 818 homes for sale, 30% from last year. Good news for buyers, loosening up a little bit. Compared to 2023, there's actually 50% more homes for sale. Now, compared to pre-pandemic, we're still missing 50% of the inventory. And that really is that scarcity. A lot of it has to do with that mortgage rate lock-in issue that we've talked about multiple times. Now, condos, this is where it gets really funky cold Medina right here. So we looking at 55% increase compared to last year, just like the Ronco commercials. But wait, there's more. This is the real big increase, 128% more inventory on the market, more than double than there was in 2023. And we look at pre-pandemic, it's actually up. There are more condos for sale right now than there were in 2019. And again, Paul, this is really just highlighting that divergence. What do you see when you look at this?
Yeah, excuse me, listed but not sold. That's the story right there. Because if you look at the sales side by side, can we do that? Can I show that other comparison? If you drop this table and let me put up yeah, if you look at sales side by side, the co-movement that you're accustomed to, there are more condos that transact in any given month. They both come down because of interest rates, but the sales volumes are moving along at about, in the same kind of general co-movement zone that, 80% correlation as I'm showing here. So what does that mean? That means the actual sales volumes, beat down a little bit by the higher interest rates, are treading along, and the pileup of inventory, the pileup is coming not because sales declined, but because the listings are somebody's just trying to get out of this market segment in
Yeah, yeah,
amounts that are far greater than what we're seeing in the single family segment.
Yes, and for sure. I mean, if we look at individual buildings, we can see that retracement of prices happening right now. Well, one of the big factors for both segments has been interest rates and where they're sitting. And if you've been waiting for that big movement in the interest rates, well, buckle up because it didn't go anywhere yet.
If you've been
But
listening to me about interest rates, it's time to stop listening to me about
that's
interest
right.
rates.
It's back on the magical mystery tour of mortgage rates. Bringing in Anders Hostelley from Rate Mortgage. Anders, thank you very
Good
much for
morning,
being here
Vince.
today. Always appreciate it. So,
Yeah.
Anders, a year ago we're talking about rates that are close to 8%. We then bounced down to 6. We were really thinking we were going to get a 5 handle. Didn't happen. Last week we're now back up closer to 7. Where are we today? A vanilla 30-year fixed rate. Hi, this is Patrick. If you're enjoying this information, please do give us a thumbs up down below and be sure to subscribe so you don't miss next month's Hawaii Housing Report.
Yeah, and I use that example of $750,000 loan, which is close to kind of an average loan amount in Hawaii, or at least in Oahu. So we're right in the mid sixes right now, 6.5%.
Mid sixes. Oh, so it's actually come down a little bit
It's
over
actually come
the
down a
last week or
little
so.
bit, yeah, in the last week or two.
Oh, that's
So
good to
that's
hear.
good. Again, it's sort of just kind of bumping around in this
Right.
range.
Right.
Mhm.
And Anders, what about adjustable rate mortgages? Where do those sit? So we're at 6.5, you said, just a vanilla 30-year. Where the
Yeah,
vanilla
so
adjustable be?
what we're seeing now is kind of an expectation, kind of, I mean, the market's seeing where rates are, and I guess there's a little less fear of inflation. So the shorter term treasuries, which adjustable rate mortgages are tied to, or have come down a bit. So like a 7 year arm, it's fixed for the first 7 years, is around 5.875%.
Wow.
Yeah.
Well,
So
so
you look at
so
the difference, yeah, with between the 30 and the 7, yeah, it's significant.
so 5.85,
5.875, 5 and 7/8.
875. Okay, 875. And then that is fixed for the first 6 years, right? At that
Yeah, it's
rate.
fixed for the first, like the example for the first 7 years. And the average life of a mortgage loan is like less than 7 years anyway. So I mean it's a really good option instead of going, for a 30-year fix. Do an
Wow.
adjustable rate and save, every month on your payment, and gives you a little bit more purchasing power as well.
Right. So your risk is in year 5 or year 7.
Mhm.
If rates have gone up, then you might reset to a different rate. And then that
Right.
also has a cap on it, doesn't it? For the
That's
months that it can
correct.
go up.
Right.
Yeah.
That's
Okay.
correct.
Yeah.
Yeah.
But that sounds like a really good alternative. So, Anders, you and I have talked about this a few times,
Mhm.
but let me just say, give an example. Someone's buying $1 million condo and they're putting
Mhm.
25% down, or $1 million
Mhm.
house, say $1 million
Okay.
house,
Okay.
and the rate is 6.5 today. If the rate drops to 5.5%, what is the difference in that monthly amount, and what is the difference in the purchasing power with just a 1% movement in the rates?
Yeah, so if you look at 6.5 to 5.5, the principal and interest payment would drop about almost $500. For a 1% drop in rate, and then when you look at that $500 difference in payment, that's about almost $100,000 in purchase price.
Wow.
Right.
That's
So
significant.
yeah, it's pretty significant. So, and we've been hoping for those interest rates to, get down into the fives. That's been kind of our, and the market talks a lot about that, the real estate, our industry, that if we can get into the mid to low fives, it'll really, really help generate a lot more,
Right.
sales and people moving and even, refinance transactions.
Well, hearing that 5 handle with the adjustable rate, I mean, that's really good news right
Hmm.
there. Just a little bit of more movement, we might be able to get down to that 5.5 range.
Exactly.
Um, yeah, okay. So let me hit you then with a little lightning round. How's that? Because you've
Sure.
been
Okay.
nailing this
Okay.
every year. Okay, so
Oh, sure.
first question: Will
Uh-huh.
the Fed lower their key rate this year?
Oh, yes. Uh-huh.
Okay, and what is your guesstimation of how much for the end of the year?
When they'll do it?
No, how much? How by how much?
50 basis points, I think.
50
50.
basis points by the
Yep.
end of this
Mhm.
year. Okay,
Right.
all right, okay.
Uh-huh.
What will the 30-year vanilla fixed loan be in
I'm,
December of this year?
I think maybe it's 6.1%. I think it's going to stay where kind of pretty close to it where we're at now, right now, maybe a little bit lower. Yeah.
Okay. I like the optimism. How about 1 year from now, 12 months later, where will the 30-year fix be?
5.75.
I like it. Okay, that sounds good.
Now Paul's he's over here listening. Oh, I don't know about
Yeah,
that. Anyway, yeah.
that's good. Hey, I'll just say it's going to be higher because that
Yeah.
seems what
Yeah.
happens every. No, no, no. It's definitely all the signs are there. We're sure it's going to happen. So, and Anders, any final advice for maybe buyers who are looking to buy right now, as far as trying to navigate this right now with the rates? I mean, it seems like adjustable rate is a good way to go.
Yeah, I think it's a good way to go. I mean, I would consider that. Look at your financing options. I mean, if you're buying a home, especially to live in, the, I mean, it's a good idea to purchase or be a owner compared to a renter.
Yeah, for sure, for
Really
sure.
is.
All
Mhm.
right. Well, Anders, thank you very much for making the time to be here today and all the information throughout the week. And thanks you also for sponsoring the mid-year real estate review. Hope you had a
Of
good
course,
time
thank
there as
you.
well.
Yeah, thank you.
And we're back with Hawaii economist and principal of TZ Economics, Mr. Paul Brewbaker. Paul, what did you think about what Anders had to say about interest rates? Do you agree? Do you think rates are going to stabilize? We're going to go down a little bit. What do you see?
There's no real reason why they ought to stay where they are right now, except for the uncertainty that's left everybody sort of on pause. The Fed would like to get on with the business of normalizing rates. Obviously, everybody else would like the interest rates to go down because as long as mortgage rates stay around 6.5, 6.75%, which you see here inverted, the dash line is on the right scale, which is upside down. As long as those rates stay in this zone they've been in for almost 2 years now, those sales volumes are going to remain low. And it's getting down to 6.5, down to 6.25, which here is up, which will bring people back into the market. Now, when you ask economists where they see the mortgage rate at the end of this year, you can see a lot of people, about half of the respondents in the survey that the Business Economists Association conducted earlier this month, about half say, just under half say 6.5 to 7%, kind of the zone we're in now. But the other half is a little bit tilted towards the downside to
Hmm.
the 6 to 6.5% range. So, we could move into that zone. And the reason is that on the right side of the screen, you can see that when economists are asked, where do you think the Fed funds rate is going to end up? It's at 4.25 to 5.5 right now. That we've been waiting for the Fed to get back into action and lowering that overnight rate. Well, the economists say, it ought to end up around 3%. That's a long way from 4.25 or 4.5%. So the Fed's got a ways to go. And as we go there, which if you look at these forecasts, they expect to happen over 2 years. Okay, it's going to take a while, but we'll get from 4 3/8, where we are right now, to 3 3/8. So there's 100 basis points in the overnight rate waiting to come. The uncertainty, which is hanging everybody up, is hanging up the stock market from going back to where it was going prior to the Liberation Day or Obliviation Day or whatever the tariff announcement on April 2nd. Right, April 2nd. Once the new Trump team came into play, the stock market. This is the S&P 500. The stock market was kind of like, what's going on? Wait, what's going on? And then plunged, but came back. And a lot of people are excited. Oh, look how much it came back! But it didn't come back to the old path. It came back to another one of these parallel paths, which means there's uncertainty hanging. That shaded area is uncertainty weighing on people's outlook. And the same thing happened with interest rates. Long-term interest rates, the 10-year Treasury note yield here, which is in the blue band, that is the benchmark for the long-term mortgage rates, 30-year mortgage rates, you know, separated from that path right around Obliviation Day or Liberation Day. And then this, again, is hanging above the path that we thought would be there because of the uncertainty. And so as the 10-year yield stays at, let's say, 430 or 440 or 450%, the mortgage rate with its heightened premium, the mortgage rate stays at 6.5, 660,
Right.
670, 680%. And we're kind
Right.
of, everything's stuck. It's kind of like
It's all stuck. And that mortgage
stuck.
premium, that in and of itself, if that would come down, rates are going to come down. But it's just that built in.
But
And you
why is
pointed
there
that
a
out
risk
early on.
premium in the mortgage rate? Because uncertainty means risk.
Uncertainty. Yes.
So everything's stuck.
Yeah. Okay. Well, good news on the horizon. Hey, let's look at the inventory numbers. To me, this was the most shocking statistic that I saw, and I still can't get over this. So we're going to
Yeah.
look at months of remaining inventory, and just as a reminder, months remaining inventory takes into account how many units are for sale, what's the sales pace or absorption rate, and we always talk about market equilibrium between a buyer and a seller's market between 4.5 to 5 months of remaining inventory. Anything higher than that number would be considered a buyer's market. Anything below that would be considered a seller's market. So here we are going back to 2019 pre-pandemic. We can see single family homes and condos trending together 3.6. May 2021, this is the buying frenzy. Rates are so low. We can see these numbers dip way down clearly in the range of a seller's market. And it obviously was. We saw the price appreciation. Now we get to May of 2024, there starts to be even more separation. 4.4 for condos, that's right around the area of equilibrium between buyer and seller market. Single family, 2.9 still in a seller's market. And then this is where it just completely blows up. So 3.6 for single family homes, trending up, but in the range of a seller's market, but 7.1 months remaining inventory on the condo side for sure in an indication of a buyer's market. What do you see when you look at these figures, Paul?
I mean, single family homes are in May 2025. Have the same sort of inventory characterization as in May 2019. Condos double the months of inventory remaining. And switch me out then. Let me show you how this looks on a seasonally adjusted basis, because I think the thing you want to be concerned about is that it's not just that it's higher, it's that the direction keeps going up for the condos. It's higher on the way to something that could be really gnarly here. These two statistics, months of inventory remaining for single family and condos, used to move together very closely, 96% correlation in the 25 years until that May 2019 benchmark, where we kind of think of what was the world like before the pandemic, and now what's the world like? Single family back to what it was like before the pandemic, but condos just out there. So and as I say, not looking like it's peaking and coming
No,
back down.
no,
I
it's
mean
heading
the
straight up.
momentum is all in the wrong direction in this case.
Yeah, and we really feel this in the market for sure. And there's really this big pileup of inventory, and like you said, the sales themselves are still pretty.
Yeah, the
They're
sales are
decent.
there.
Yeah, but just this pileup of inventory, and so much of it has been this affordability issue.
We
So
we need to start asking people, why are you selling? And why do you think your unit's going to sell when there's this huge pileup? I mean, are you, or is the pileup leading you to freak out, right? 'Cause remember the psychology here. Wow, those guys are all bailing on condos. Maybe I should bail now while I still can, because it's going to get worse.
yeah,
That's the expectations part of the problem we need to.
small segment, small sample segment, but a
Yeah,
lot of people have to sell because of the affordability issue, the
yeah,
assessments, and that
yeah.
increase in the insurance premium. Now, maybe something will come up next year through the government agencies, but right now it's devastating. It's tough, and you can't rent the
So,
units for the cost to hold them.
so the insurance, the maintenance, the property tax, it's all kind of just burning through their ability to stay in the unit or
Yeah.
continue to be an investor in the unit.
Yeah, it's been tough. So, Paul, let's shift gears and take a little look at the neighbor islands. And I think you've got a big presentation coming up for Maui. Do you just want to share a little bit of data, just kind of give us
Just
an idea what's happening there?
just a flavor. I haven't spent a lot of time working with the neighbor island realtors of late for one reason or another. Maui has invited me to come back in July and have a conversation. So I'm starting to go through those data sets, and they've been generous in providing a lot of all the granularity, so I can really dig down. But we do have data sets that allow us from the Federal Housing Finance Administration that are indices of broad measures of housing valuation. So single family condo combined. Remember the characteristics of the neighbor islands? The condos tend to be more resort oriented. In Honolulu, the condos tend to be more urban core oriented, tend to have a more residential character than a resort character. But otherwise, you can see the co-movement over what do we have, 50 years of data here. And the one thing that jumps out, that's just a reminder for those of us who are participating in neighbor island markets or interested in investing in markets, there's more of a roller coaster in those neighbor island markets in the valuations, and these are adjusted for inflation. I want to say, let me make sure I'm not getting that right. Yeah, this is a real index. So I've taken out the inflation, I've taken out the seasonal variation. And so, for example, in this post COVID-19, right, in this early 2020s mini bubble, where we've talked earlier about the separation of bubblicious single family home prices, maybe reflecting a remote work driver that's not as active in the urban core condo segment in Honolulu. On the neighbor islands, we see much more bubblicious outcomes. And here's another scary thought. At the peak of the most recent overshoot for neighbor island valuations, valuations are barely higher after inflation than they were in 2005.
Wow.
So, ooh,
That's
ouch.
interesting.
Now,
Yeah.
in the long run, you're there. In the long run, you get 2 to 2.5% appreciation in real terms. That's the sort of the capital gain. You get compensation for inflation because I've removed the inflation, so that's going to come back in. And you get the dividend, which is you get to live in the house or you get to rent it out. This is an asset class that performs well over time. But because of that cycle, if you're on a big roller coaster, when you go way down, you go way down. And it
Yeah.
takes a while to get back. And that's kind of where the neighbor islands are right now.
Oh,
One way to think of it, an optimistic way to think of it, is
hmm.
they're at a point where you can start to think about what the next wave looks like out into the 2030s and the 2040s.
Yes.
And the reason it's important to remember that these long waves are there is that the valuations don't happen, the valuation dynamics don't unfold on their own. A critical element is how much are they letting you build? And in the
Mm,
neighbor islands, it's not that much.
no,
The
no.
supply side is constrained. Now,
Yeah.
does that put a floor under valuations? Yeah, a little bit, but it also makes affordability way more
Yeah.
complicated
Yeah.
and
Yeah. That's
and
been,
access to the housing market way more
yeah.
complicated.
NIMBYism and the neighbor islands is strongest.
Unfortunately,
Yeah, yeah,
yeah,
that's just a
yeah,
fact. Look, okay, before we get to your predictions for the rest of this year, I know you're very familiar, and as long as we're talking about Maui, if you don't mind touching on it, there's the big vote coming up, and they're trying to knock out all short-term rentals and all of that.
yeah.
What's your 2 minute take on that?
It's not that hard. So here's the question. Let me pose the question to you, Patrick. I've got this idea. There are 20,000 lodging units on Maui. Let's take 6,000 of them and downzone them so they can no longer be operated as short-term rentals. What's that going to do to tourism? Turns out, if you look at the kind of people who stay in the units we're talking about and how much they spend, which is not as much as people at the Grand Wailea or the Four Seasons, I'm just saying, it's about what's 6,000 units out of it's actually 21,437. So it's 28% of the units, 19% of the expenditure. Tourism is 29% of the economy. Okay, in round numbers, 20% of expenditure in 30% of Maui GDP. Zero point 0.2 times zero point 0.3 is a 6% decrease in Maui GDP and the loss of 5 to 7,000 jobs, depending, or 8,000, depending on how much of the multiplier effect you include. And that's a worst case calculation. UHERO has one that's not as big for reasons I don't believe. So take away a chunk of the economy, cause 7 or 8,000 people to lose their jobs. Hey, they'll really be paying rent after they lose their jobs. And you get 6,000 housing units. Or that's option A. That's our plan. Or option B, build 6,000 housing units
Yeah, exactly.
and keep the tourism.
It's such an easy sell
It's
for
not that
political
hard.
purposes to say the reason you don't have enough housing is because of those guys right there, not the fact that we won't permit it and we don't go out and build more housing.
Yeah.
Okay, let's move into the lightning round. And these are Paul's predictions for the rest of the year. So, Paul, we've seen single family price growth of 8% so far this year. What do you think will end this year on single family price growth?
Honestly, I think single family is reverting to trend with a little bit of a premium, maybe an 8% premium, but the trend was 4%, not 8%. So I'll say eventually we get back to a 4%, maybe 5% trend, but probably a 4% trend.
Okay. Okay.
Condos,
Condos. Yes.
condos kind of
Condos.
look like more sideways to me.
Yeah. Yeah. Okay. That makes sense. Okay. And then in December of this year, what do you think the 30-year mortgage rate will be? We're at 6.5-ish right now.
Yeah, I'm gonna say 6.35. I'm
Okay.
gonna say after July, maybe September, maybe by September, there will be enough resolution of the uncertainty about trade policy and tariffs, and the Fed will resume its original plan of reducing interest rates. The bond market, reassured by that, will bring the longer term rates down. Caveat: the budget bill, a problem. The foreign reaction to U.S. fiscal policy and trade policy and geopolitical policy posture writ large, all of those things problematic. And to the extent that foreign investors start moving away from U.S. treasuries, and to the extent that the Congress adds to the deficit and adds to the debt, the long-term rates won't come down as fast or as much. Just that's a risk factor.
Yeah. Yeah. It's pretty simple. And then let's look out 1 year from now, 12 months from now. Where do you think the 30-year interest rate will be?
Man, I want to see a sub 6 number
Yeah.
so bad.
Yeah. Yeah.
I think it'll be within 25 basis points plus or minus of 6%. And
Okay.
I hope it's to the downside.
Yeah. Yeah, I think we all do. Well, Paul, thank you very much for all the insight and your time today. And if you're watching this and you enjoyed it, please give Paul a thumbs up down below and be sure to subscribe so you don't miss next month's Hawaii Housing Report. So until next time, be well, be kind, and aloha.